This past year, I put $17,000 towards this strategy, another $1.3 million for 24 clients to make their financial situation peaceful. That is called indexing. First, since the goal is peace, the two things we want to eliminate right away are market volatility and tax rate volatility. My clients and I have no interest in losing money when the market goes down and no interest in paying more taxes if the government decides at a whim to raise them. The next thing we want this money to do in an ideal world is to have it with a safe institution, not only to opt out of tax rate volatility, but have it be tax-free, have it be liquid so we can access it whenever we want, and to have the rate of return not be sacrificed in order to gain all of these benefits. We're doing all of this through what is called indexing. The first step here is to get credited fixed interest, that's interest we can rely on from a bank, an insurance company, and then using only that interest, no other money, to take risks. If this is the case, when that money performs very poorly, when it gets completely eliminated, we don't lose any of the initial money that was getting credited the interest. Our principal's protected, we only lost the interest. So when this is the case with the strategy I'm implementing, I cannot lose because the market goes down. So here's how it actually works. When we're getting credited interest, kind of like how a bank is able to credit you interest in a high yield savings account, say 4%. They are able to do that because your money is sitting in the bank. They are taking that money, investing it, earning a higher rate of return than 4%. Therefore, they can credit you that 4% to incentivize you to keep your money in there. They'll keep paying you. They're going to keep earning an arbitrage on that money. That's how they're going to profit and run their business. Now, insurance companies are doing the exact same thing. They have what's called a general account portfolio rate. They are investing typically much safer than banks are. Why? The government won't even allow them to be as risky as banks, and their loan to value ratios, again, are required to be much lower. But still, those general account portfolio rates are going to be comparable to banks. Say they're earning 5%, they might be able to credit you 4%. So that's where I'm getting the interest. And then we are using that interest to buy options. This is where we're quote unquote taking risk with the interest. So here is how options work, to zoom out here for a little bit. If you had a home that was worth $100,000 and I wanted to buy that home, but I didn't want to buy it today, I wanted to buy it a year from today. I'm worried though, I don't want the home to skyrocket in price. I kind of want to lock this price in here and have the option to buy it at the price it is today, a year from today. If the home plummets in value though, I don't have to exercise that option. I have the choice to say, no thanks, I don't want to buy the home for $100,000 since it dropped. Now, here's the deal. If that home goes up in value to $110,000, I can exercise that option and still buy it for $100,000. That means I just bought the home for $100,000, but I own it now and it's worth $110,000. That means I just gained $10,000 without ever putting the $100,000 in the home initially and hoping that it didn't drop. None of my principal was ever at risk. All that I did to have the choice to do that was pay you an options budget. Say that was $3,000. If that was the case and I had $100,000, if it was in a spot where it was only gaining 3% interest and I paid you that $3,000, I just used that interest only to have the opportunity to make 10% on my money without ever risking the principal. Now here's the great thing. If the home goes down in value to, let's say, $80,000, do you think I'm going to exercise that option and buy the home for $100,000 when I could just buy it for $80,000? Of course I'm not going to buy it for $100,000. I'll just buy it for the much cheaper amount. And in this case, I lost the $3,000 that I paid you as the options budget, but the $100,000 that I have is still safe. This works the exact same way with an index. So instead of it actually investing in the market, what we're doing is we're linking to an index through options. So what I'm doing, take the S&P 500 for example, is I'm saying I want my $100,000 to link to the S&P 500's performance. And what I mean by that is I'm getting credited 4% interest. I'm going to pay you that $4,000 to decide if I can buy the S&P 500 for the price it is today, a year from today. When I do that, if the S&P 500 goes up, let's say 10%, do you think I'm going to exercise that option and buy it right before it goes up 10%? Of course I am. I just made $10,000. None of my $100,000 was ever exposed to the market risk. Now, if the market goes down at 10, 20, let's say 40%, am I going to exercise that option and buy it right before it goes down? Of course not. So in this case, my $100,000 is safe. I lost my $3,000 of interest, but everyone else who was invested directly in the S&P 500 just lost 40%. I would have gained when the market went up, just like they would have gained. However, when the market crashes, they all lose. I am completely safe. Then when you make those gains, now that we have, let's say it's the 10% gain, we now have $110,000, we are able to lock in those gains and reset. That means now we're gonna get credited interest on the $110,000. That's our new principal. So instead of getting $3,000, maybe this time we'll get $3,300. If it was 3% interest, we can use that as our next year's options budget. And if the market goes down, our floor is $110,000. So even though we did make gains last year, those were gains, those weren't initial principal, it's considered new principal. Now it's protected, and we don't have to worry about losing that money because the market goes down. So just with what I've explained so far, we have gotten rid of market volatility. We have a safe institution within the insurance companies, much safer than banks. We also have not sacrificed our rate of return. Next, what we need to eliminate to make this ideal is tax rate volatility, making the money tax-free, and most importantly, keeping that money liquid if something were to happen and I need access to it. What we are going to use is maximum funded indexed universal life insurance, otherwise known as an IUL, that is structured properly. That means the most possible amount of my premiums going towards the cash value, the least amount possible going towards the death benefit. The reason that we're doing this, aside from the fact that they're able to credit us interest and they're able to buy options at a much more discounted rate than we would be able to do ourselves, is because since this is going to be considered life insurance and not an investment, that's because most of it's cash value, the rest of it's death benefit, we're complying with the IRS tax codes. Since that is the case, this money is actually going to grow tax deferred, and we can access this money tax-free via withdrawals up to everything we put in and policy loans above that we don't have to pay back. The death benefit will completely tax-free. That means when we pass away, if there's a loan balance, the death benefit will pay that off, and the rest of it is going to transfer completely income tax-free. So I'm funding this policy, I'm having the least amount going towards the death benefit, the rest going towards the cash value. That cash value is getting credited interest from the insurance company's general account portfolio. With that interest, they are buying options on an index that I select, like the S&P 500, for example, and based on the performance of that, they are crediting me interest. If the market goes down, I don't lose. So in my personal policy here, I'm actually putting $17,650, 24 cents a year, random number. All I am doing is I'm gonna have to pay the early year fees. Yes, it's a long-term vehicle. It's not a short-term solution. If we want that peace of mind, we have to be able to wait. But in exchange for paying those early year fees, in 30 years from now, I will have never lost due to any market downturns. I will have that money completely tax-free and an internal rate of return of 5 to 7%. That's post fees, that's post taxes, post everything. I can have access to that money and actually a chance to earn a little bit of arbitrage on that. We go in that in another video. And most importantly, with my finances, I am at peace. This is for me, someone who's much younger, can afford to take on more risk, but for someone who's much older, who's maybe approaching retirement, this isn't a game that they're willing to play. A lot of the times, maybe they remembered the decade between 2000 and 2010 where the market dropped 40% twice. People got to the end of that, they call it the lost decade for a reason. And they think, if I would have retired during that decade, I would have had to go back to work. I don't know what I would have done. Now with Social Security, people are living much longer. It's not a game that people want to play. For retirement planning might be different than at retirement planning. Hopefully this was helpful and you could see the goals that we were aiming at and why we want those things, why they're so crucial, especially for retirees. If this is something you'd like to learn more about, I do ask you to subscribe. I release videos like this 5 times a week going into much greater detail. I will see you there. Bye-bye.